Welcome back, friends. We just got some major fresh commentary from CATHIE Wood, where she talks about the latest auto sales numbers from the US, and what that potentially points to, in terms of EV adoption globally. She also went on to discuss the current rotation in stocks from value to growth stocks, and for how long that might continue. Let's listen in to what she just said.
Another statistic that we got this week that was interesting and unexpected was auto sales. The unexpected part is that they came in at 15.4 million units. Now this is just a U.S. number, which we tend to get U.S. numbers more quickly in a more timely way. So 15.4 million units. The expectation was more than a million higher, so 16.5, and the previous month was 17 million. Now here again, we're hearing a lot about shortages. There are chip shortages, and so all the automakers are saying that they're having trouble getting all the chips they need to build their cars. And of course, we know the used car market has been on fire as well for that reason. So maybe that's all this is. I don't know. Or I'm beginning to think, is this shift towards electric vehicles moving into higher gear? And just to give you a sense, electric vehicle sales last year were 2.2 million units globally, including China. Now that was out of a total somewhere in the 80 to 85 million range. So 2.5–3% of total sales. So there's a long way to go if we're going to get to our expectation of 40 million units in 2025. And we should see that acceleration occur now as prices continue to fall and as more electric vehicles are put on the market, more from more companies. So what if that is happening? We're going to be listening carefully to the auto earning reports, and I think there will be a lot of obfuscation, not necessarily intentional, but we have the chip shortage, that's real, and we have the shift towards electric, that too is real, and maybe we need the shortages to diminish before we understand what's really going on here. But I do look at moments of crisis, and the last year certainly was that, for big changes. And while we've been surprised to see auto sales pick up so much, it makes sense in that most people who have taken mass transit historically decided they're not going to do that, or they're either going to continue to work at home or they'll buy another car. So the sales have been very strong for that reason. But again, we're going to normalize here and really see what's going on. So we'll be paying attention during the next 6 months forward. And now on to the markets. As we've said all year long, this bull market has strengthened. It has deflected all kinds of bad news. The doubling in interest rates in the first quarter, the Archegos leverage blow up in the ecosystem, which many thought could cause systemic problems. We've been through tax hike discussions, which sounded pretty onerous in terms of their impact on capital. And we've seen a big correction. We certainly were right in the middle of it in valuations as those interest rates went up in the higher valuation side of the market, particularly if one is looking at valuations as of this year on this year's earnings. So we're very happy at the way the market has performed. It's up double digits, and we've seen now a shift, a rotation back from value as some of these prices have started to unwind, the commodity prices in particular, towards growth. But I think we're going to see toggling back and forth until some of the confusion that I'm discussing here dissipates. What's clear is profit growth right now has been, or is, explosive. I think for the second quarter, at an annual rate, the S&P is annualizing earnings at $220. So that's roughly 19, 20 times, really effectively trailing earnings. And if we think earnings are going up, and we do, then the multiple looking forward is moving down into the mid to upper teens. That is good valuation support given the level of interest rates. But if we're right, and there is an inventory cycle brewing here, and there are wage pressures brewing. I mean, we hear headlines of all the labor shortages, and in fact, the JOLTS index, so that's the job openings index, it shot up to an all-time high, another all-time high. 9.3 million jobs are just waiting to be filled. There is either a skill set mismatch, or the wages are too low, and so we are seeing a lot of industries increasing wages to try and attract labor. Now, we do have many people still out on their stimulus checks until the end of September. That's in the lower wage categories. So that supply will come back in, and JOLTS, that number, 9.3, will go down. So that could take an edge off of the inflationary ramifications and the margin pressures associated with wages. And I do believe, if we do go through this inventory cycle, and we see some profit pressure caused by costs, especially wages, that the market will become more discerning. I think that the shift towards growth will gain more momentum if this happens, because cyclical earnings growth will provide less competition.
It's truly reassuring to hear the market veteran CATHIE Wood holding on to her conviction about the EV adoption cycle and the overall future of growth stocks in the coming months. The NIO stock finished above the crucial $50 mark this last week, which we believe is a crucial level. As long as the $50 level is strongly supported, we could be easily looking at a fresh all-time high in the NIO stock anytime in the coming few weeks.